New inflation numbers here in Canada were printed this morning. 1.9% was the annual pace of inflation growth price growth in the month of January. We're joined now by Pedro Antunes, chief economist at the Conference Board of Canada. Pedro, thanks a lot for joining us. What's your take on these numbers? It's sub 2%, but did increase somewhat from December's pace.
Yeah, I guess nothing too surprising there. We might have expected to see inflation coming down a little bit more given the retail sales tax holiday in the first full month of that holiday. But energy prices, they tend to swing things around, and that's what's kind of keeping the overall number a little more elevated, a little higher than what we saw in the prior month. I think the kind of underlying piece here is that this retail sales tax holiday is temporary, and so we are going to see in the next month and the next couple of months, in fact, inflation kick back up.
Yeah, that was my next question. How should people be thinking of that sales tax holiday in terms of skewing the numbers in a way that will not be durable?
Yeah, well, we did kind of a preliminary look at the impacts. We think it could take as much as 0.5 percentage points off inflation in the full month. We haven't quite seen that now. Perhaps there's been, some of that skewed by what's happening with energy prices, and generally inflation is not quite subdued. We're seeing that certainly in the core inflation numbers that are still running above 2.5%. So I do think that we will see a good tick back up in the overall, like the kind of overall inflation numbers once the tax holiday comes off.
How much of a risk factor is the threat of tariffs from the United States to inflation in Canada in particular?
Well, I think the most direct influence will be with the weakness in the exchange rate. We're already seeing a lot of weakness in the exchange rate. There's two things really affecting the value of our dollar. One is the fact that inflation in the U.S. has kept up and interest rates have not come down, and so that's tended to the fact that interest rates are higher in the U.S. That's tended to lower the value of our currency. And on top of that, of course, is the tariff threats. I don't think markets really believe, I just don't see evidence that markets really believe that the tariffs are coming on full force, because if they did, I think we'd see a much weaker currency. In any case, the value of the dollar is already very weak, and that will drive inflationary pressures down the road. There's no doubt about that. Everything that we import, we're paying a little more for these days.
And what about retaliatory tariffs from Canada? They would likely drive inflation higher as well. They would present an upward influence on inflation, correct?
Yeah, there's no doubt they would put some pressure. I think, when we look at the plan that the federal government and the provinces are working on, they're really trying to target things that we would have substitutes for. So, we hear about things like orange juice or bourbon from Kentucky. I'm not quite sure what the list entails, but the idea there is that there are substitutes. And yes, they would create some inflationary pressures, but hopefully we're targeting things that will minimize that impact on Canadian consumers. And
you just said that you're a bit surprised at the strength of the Canadian dollar. If I understood correctly, the Canadian dollar seems not to be, the Forex market, not to be pricing in the full brunt of 25% tariffs. That the view that this will all get negotiated either away or down is still very much out there, as you know. If the Canadian dollar moves significantly down from here, how much of an influence on inflation is that?
Well, it's critically important because, much of what we consume is imported. You can think about food prices that have already taken a real hit to the purchasing power of Canadians. I mean, especially at this time of year, we're not growing produce here in Canada, or at least very little. And so, we'd feel an immediate impact on especially food items, but even durables and other goods as inventories wear down. Much of what consumers purchase in terms of durables and semi-durables, you can think of clothing, footwear, all of that stuff. The prices would go up, and they'd eventually go up one for one. So if we see a 3% depreciation in the currency, or a 6% depreciation in the currency, which could very well be even higher if 25% tariffs do kick in, I'm afraid for the value of our dollar.
Okay, let's go. Let's finish with Canadian business investment. How are businesses reacting to all of this uncertainty?
Well, we're hearing already a lot of concern around access to the U.S. market. I think this is really a repeat of what we saw in 2015, 2016, when President Trump's first term came in with that threat of dissolving NAFTA. And so I think we're seeing much of the same here. It's a very difficult investment environment for Canadian firms here, with that fear of not having access to the U.S. consumer. I don't know how to compete in this environment. I think part of the reason we don't think the tariffs will really come on is because the strategy of creating this uncertain environment with the threat of tariffs is enough to move that business investment south.
Pedro Antunes, thank you as always for your insight. Chief Economist